So it's getting to be that time again, a new year is coming, and I decided to put this video together highlighting some of the leading dividend stocks going into 2022. If you've been following the channel, you know that I'm more of an ETF kind of a guy, and because of that, I started this research process with SCHD, which is a collection of some of the absolute highest quality dividend companies on the entire stock market. And then I used an independent rating website like this to get an overall consensus of the stock. And then of course I also look at the numbers to confirm whether or not these are successful and growing companies with sustainable finances. So hopefully this is a quick and painless video and you guys get something out of it. If you do, as always, leave the video a like, subscribe to the channel, helps me out a lot with the YouTube algorithm and I greatly appreciate it. Okay, so my first name on this list, and by the way it's no particular order, is Broadcom. And if we come over to SCHD, this is their second largest holding at the current moment. So Broadcom designs, develops, and supplies various semiconductor devices with a focus on complex digital and mixed signal complementary metal oxide semiconductor based devices. The company operates in two segments: semiconductor solutions and infrastructure software. And here's a list of various products that this company actually produces and sells. Now in terms of the independent ranking, this currently has a 9 out of 10 with a strong buy consensus. I really like the crowd wisdom section of this website, and we can see the overall investor sentiment right now is very positive. And that sentiment is based off of 534,000 portfolios. So definitely group wisdom here. The company has appreciated 56% in the past 12 months and has a PE ratio of 20.1. And when it comes to the overall finances of Broadcom, this is a company that is extremely well managed. Just scrolling through this, they have some of the prettiest financial data I've ever seen for any company. Last week, Broadcom increased its quarterly dividend by 14% to $4.10 per share. The increase wasn't much of a surprise, but what was a surprise was $10 billion of stock buybacks announced. And this article just goes through all of the data like the earnings and the dividend for the company. And the overall takeaway here is that this company is excellently positioned in its current market and management is dedicated to returning cash to shareholders. And they're achieving that in two ways. The first way is that intense share buyback program and their aggressive dividend. The past 5-year growth rate is an average of 42%. And based off of this news, Broadcom has spiked recently, so you might want to wait for a better buying opportunity, although there's no guarantee you're going to get one. All right, moving on. The next one here is Blackrock. So Blackrock, this is a publicly owned investment manager. The firm primarily provides its services to institutional, intermediary, and individual investors, including corporate, public, union, and industry pension plans, insurance companies, third-party mutual funds. We also have things like fixed income, real estate. So basically anybody that does any kind of investing, BlackRock is here to help. They currently have a 9 out of 10 rating with a strong buy and pretty bullish sentiment all around. The stock is up almost 30% over the past 12 months and has a PE ratio of 23.59. And much like with Broadcom before, the finances of this company are extremely solid and of course they're extremely profitable. And all of that supports a very healthy and fast-growing dividend. BlackRock has established itself as the largest asset manager firm in the world, even surpassing Vanguard, which comes in at number 2. The profitability and growth make the stock outperform both the market and the financial sector itself. And as we saw, BlackRock is committed to growing income distributed to investors. The company's business model has delivered strong performance and efficiency as it revolves around innovation and offering a wide range of products to a diversified client base. While micro trends in the investment management industry and BlackRock's own growth and profitability performance project a very promising decade ahead. Okay, now following that, I have Lockheed Martin, ticker symbol LMT. So this company, for those that are not initiated, Lockheed Martin Corporation is a security and aerospace company engages in the research, design, development, manufacturing, integration, and sustainment of technology systems, products, and services worldwide. It operates through 4 main segments: aeronautics, missile and fire control, rotary and mission systems, and space. And for me, this final bit about space is actually a really big deal for this company. This right here takes the company beyond just a defense company and into the vast possibilities and innovation that the space industry might provide in the future. And aside from SpaceX, which is currently a private company, this is probably one of your better space-related investments. It currently has a 9 out of 10 rating, and we can see here a lot of green across the board. Now, unlike the previous names on this list, the stock is actually down 1.3% over the past 1 year, and the PE ratio is a very attractive 13. Much like with the other companies on this list, the finances of this company are rock solid. The dividend is very healthy and the growth rate is almost in the double digits. And because this stock hasn't raced to the moon like most other stocks over the past couple of years, the dividend is very high at over 3%. So for those value dividend investors out there, I think Lockheed Martin is a phenomenal choice right now. Strong US government exposure offers a clear revenue runway for Lockheed Martin. This is Lockheed Martin's revenue by customer, and we can see the US government is a major client. President Biden's proposed budget for the Department of Defense for year 2022 is a massive $715 billion, up from $704 billion. And Lockheed Martin is going to be a prime beneficiary of this, and along with future interest in space for defense and asteroid mining and all these things, I think this provides a lot of growth for Lockheed Martin. Now, the last company on this list is Home Depot. In comparison to Lockheed Martin, it's super basic. We all know exactly what it is. And sometimes these simple investments turn out to be the best investments. And right now, Home Depot has a 10 out of 10 rating and super bullish across the board. Their payout ratio is very healthy and they're growing their dividend by almost 20% per year. The only downside I would say is that the starting yield is less than 2%. And that's because the share price has grown a lot in the recent years. In the past 12 months, up 47%. And that crazy share price growth is even outpacing the growth in their dividend, and that's why the yield is declining. So the biggest risk with Home Depot is that their valuation is a little bit on the high side. Their PE ratio is 25.65 at the current moment, but without a doubt, Home Depot is one of the highest quality companies on the planet. So that's the video. Hope you guys enjoyed. If you did and you're still watching, you know what to do. Leave the video a like, subscribe to the channel, helps me out a lot and it's greatly appreciated. But regardless, I'll see you guys in the next one and have a good and profitable 2022.